It looks like the Federal Reserve finally decided to cut interest rates. Unfortunately, we may be going in for a recession soon. So we're going to react to some of this stuff that's going on now, starting with Graham Stephan talking about the actual interest rates being cut. And then we'll go right on to why I think we're going to be in a recession very, very soon.
What's up, you guys? It's Graham here, and you better get ready for what just happened. As of a few hours ago, believe it or not, the Federal Reserve just lowered interest rates for the first time since last year, officially marking the end of the most restrictive tightening cycle in history. Yes, you heard that correctly. The money printer is turning back on once again. And that means there's going to be some pretty serious implications across just about everything, from the stock market, the housing market, the national debt, and even the value of the US dollar. So given these shocking new updates and their brand new predictions as of today, let's talk about exactly what just happened, what the Federal Reserve just said, the impact this is about to have on everything money, and then finally, how you could use this information to come out ahead profitable. Because there's a lot going on under the surface that very few people are talking about. Although
I can tell you with interest rates now being cut, money's about to be a whole lot cheaper. Typically, the Federal Reserve does this when they need to put a jolt in the economy. So people in the real estate market that have been holding out, waiting for interest rates to go down, now they're going to start getting into the market. You're going to see people borrowing more money, whether it's to improve a business or to throw it in the stock market. That was what was going on in years prior, back when we had the COVID pandemic. So looking forward to seeing how this goes.
Before we start, if you appreciate these breaking news videos like this, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. Thanks so much, and also a big thank you to the Gemini credit card for sponsoring this video, but more on that later.
Don't trust it. Don't trust it. Anytime these finance YouTubers, finance creators hype up a credit card, or just don't do it. We all know the issue that happened with Yada Bank. Hey, quick pause. So the video you're watching right now is actually a clip from a recent live stream. So if you want to join the conversation in real time, hit that subscribe button. I go live on YouTube every Thursday and Friday at 4 p.m. Eastern time. So come on in, join the conversation, and let's get back to the video.
Let's talk about the topic on everybody's minds, and that would be interest rates. Even though our economy is so far overall still healthy and GDP is continuing to grow, Jerome Powell finally admitted that the downside risks are rising, and as a result, he recently said the conditions allow us to proceed carefully as we consider changes to our policy stance. This is completely different from what we saw a few months ago, prior to shockingly low job numbers when the Federal Reserve strongly resisted these rate cuts. Even now, we have inflation creeping back towards 3%, revised job numbers that continue to decline, and a weakening US dollar, leaving people wondering, why all of a sudden is the Federal Reserve cutting rates now? Well, like it or not, it all has to do with one topic that's been grossly underreported, and that would be jobs. Like I mentioned earlier, the Federal Reserve is in charge of maintaining policies that promote a healthy labor market, or I guess in other words, an economy that keeps people steadily employed. And as it turns out, a lot of people are falling behind. For instance, the Bureau of Labor Statistics just revised their job numbers down by the largest amount on record, showing a loss of 1 million jobs, more than they originally expected.
And that is happening no matter what sector you're in. We're seeing it in tech, we're seeing it in industry jobs, we're seeing it in the trades even. It's hard out here to find a job nowadays. Like, we are not only in an employer's market right now, but we are in a very, very hard market.
Even said that this was more than 200,000 deeper than economists predicted, and it's worse than the 2008 crisis levels. This is why some experts have now begun to say that the Federal Reserve is too late to cut interest rates, and that a lot of this could have been prevented ahead of time had they eased their policies and cut rates sooner. On top of that, others believe that the Fed rate cuts now signal that 3% inflation is the new 2%, meaning they're never going to get prices to come back down to where they were before.
I need y'all to hear this. 3% inflation is the new 2%. So everybody who's waiting for inflation or for interest rates to be rock bottom the way we had during the pandemic, it's just not happening anymore. I'm sorry to tell y'all.
And potentially causing even more inflation. Unfortunately, on May 16th of this year, Moody's downgraded the U.S. in terms of their future outlook, going from what's called a AAA rating to AA1, meaning that investing in the United States is no longer as enticing as it used to be in the past. And that's why they project that by 2035, interest payments will make up 30% of the total budget, which is insane.
Which is still insane to me, to the amount of debt that we're in, the fact that our interest rates are so high. But what else can we do? Like, we're literally spent the last 5 years just printing out cash left and right. And we did say this entire time that if you didn't resolve that soon, you were essentially just kicking the can down the road. And now look what happens. Now we're dealing with the economy that is, honestly, on paper, it looked okay. But in real life, people were losing jobs left and right. People are on unemployment more than we've been in the last couple of years. The stock market looks nice, which is what everybody agrees with. But unfortunately for the people down on Main Street, as we call it, we're struggling out here.
Insane. Now, even though the United States has never defaulted on its debt, and realistically probably never will, this does suggest that the US will have no other choice other than to continue printing more and more and more money. And if you are investing,
and they will keep printing more and more money because a lot of the time that they owe that money really to themselves within the country. There's only a select like foreign countries that we owe money to. So they're just theoretically going to keep doing this over and over.
investors are there to buy that debt, the 10-year Treasury could continue to remain high, and that is where a lot of the problems begin. Let's talk about the housing market. In terms of what we're currently seeing, it's no surprise that housing prices are beginning to slump as more inventory gets listed on the market. And
not only that, with the housing market, what we're actually seeing is that a lot of homeowners are having a hard time even selling their homes now. One, because prices are through the roof and ridiculous, but also because a lot of people who own homes are scared to like leave their homes, get a new mortgage where their new rates are going to be triple what they got. Because a lot of people were buying homes during the pandemic with like sub 2% interest rates. Now you're going from that to like almost 6% over. So it's a lot of inventory going on, but also a lot of fear in the market. But when they start cutting these interest rates down, then that fear is going to be alleviated, which means you're going to see a lot more people back into the markets.
for the first time in years, housing is beginning to lag inflation. In fact, it's said that American housing wealth has actually declined in inflation-adjusted terms over the past year. What's even more apparent is that we're quickly noticing a very big divide in the housing market between those who locked in historically low mortgages and those who bought in the last 2 years. Like, as you can see, the average existing interest rate on California mortgages is currently at 3.8% versus new mortgages coming in at 6.6%.
Okay, I was wrong. So they're actually, mortgages now are like double. The average rate on existing mortgages and the average rate of new ones are now double. But I was talking about more like pandemic levels where it was really low. Favorite splashes, tired of streaming to zero. Oh my gosh, the bots are out here on Kick. No, I am good.
This means you have one segment of the market locked into low interest rates and refusing to move, while the other is paying double for an identical house. Given that, when a home is listed, room to negotiate. They can afford to be pickier because there is more to choose from. And when you look at the overall buyer pool today, there are fewer people willing to pay today's prices that haven't already purchased something. Of course, in terms of whether or not lower interest rates are going to positively affect the housing market, the answer is it depends. Unfortunately, like I mentioned earlier, the Federal Reserve does not have a direct impact on mortgage rates. Instead, those are influenced by the 10-year Treasury yield, which are dictated by market supply and demand. That's why there's a good chance that mortgages will remain relatively unchanged for the near future, unless the Federal Reserve starts buying the 10-year Treasury yield in an effort to pump more money into the market and drive those yields down, which at this point, nothing would surprise me anymore.
Well, I don't know about the investors, but the average person in the US has pretty much lost faith in the economy, and a lot of people are just waiting for it to fall.
Barring the Federal Reserve purposely stepping in to bail out the housing market, realistically, housing prices will continue to soften as more inventory gets listed on the market and prices might begin to decline relative to inflation. On top of that, national home prices have remained fairly stable, so it's unlikely we're going to see a crash, but a softening is definitely something that's in the cards. Although a bigger problem right now might actually be the stock market. Unfortunately, we have a few variables all affecting stock market performance, with the first being treasuries. Like I mentioned earlier, for the foreseeable future, the long-term treasury yield is going to act as the barometer for our entire economy, because this is seen as the risk-free rate of return that every other investment is compared to. Like, to put this into context, if the 30-year treasury offered a risk-free, guaranteed 10% rate of return, Why would you invest in the stock market where you might get an average of 8%? Or why invest in real estate for a 7% return when you could invest in this with no risk or work whatsoever? That's why the more these long-term yields offer, the cheaper other investments need to become in order to compete. And this is what brings us to the first issue. Treasury yields have been rising. In this case, investors are worried that deficit spending is growing out of control. Core inflation is back near 3%, and if the US dollar loses some of its appeal, the market could fall because Treasury yields will rise.
Which, honestly, if the market does fall for any reason at all, I will be getting in there.
Second, we have concentration risk. As you can see, the top 10 companies now make up 40% of the entire S&P 500. And even crazier is that Nvidia now has the biggest weight in the S&P 500 of any individual stock since.
And I just finished talking about this. I released a video back on Monday where I talked about financial stocks and should we get into that. And part of the reason why I said it was because for the longest time, the S&P 500, which is the 500 biggest companies in the US, was pretty much being held by the Magnificent Seven. So your Nvidias, your Apples, your Teslas, Microsoft, etc. And that seems like it's starting to shift as well with all these changes going on in the market. But who knows? We may be in for a crazy market shift in the next couple of months to a year.
The data began in 1981. This is bringing us to a very close comparison to the early 2000s .com bubble, where at the time the top 10 companies made up just 25% of the index, which, hey, back then that was a big deal. However, even though market crashes have historically followed periods of high market concentration, like we're seeing now, the data actually shows that market concentration alone doesn't predict future stock market performance. Why? Well, sometimes market concentration is earned by fundamentally strong companies who make a ton of money, while other times it's fueled by speculative mania about to burst. That's why a more reliable indicator of a market bubble is simply how fast the market concentrates. And the faster this occurs, kind of like what we're seeing with Nvidia, the more vulnerability there is for a drop. Of course, that's not to say that we're due for a crash or that the market will just keep going up indefinitely, but it is a reminder of why it's so important never to put all of your eggs in one basket and prefer.
I won't say that we're due for a crash, but I think as a country, we are overdue for some kind of like major correction. I think they said like there's a correction that goes on every 9 or 10 years, and we haven't really had those. We've had periods where like it's like a slight correction and then it goes back up, but we never had anything deep. So who knows? Maybe we are due for one at some point.
Preferably to diversify across as many different asset classes as possible. Although in terms of what Jerome Powell just said and what this means for you, here's what you came for. As of a few hours ago, the Federal Reserve cut interest rates by 25 basis points, mainly due to one segment of the market that's really beginning to suffer, and that would be jobs. As you can see, for the first time in 4 years, the United States officially has more unemployed people than there are job openings. And this means lower interest rates are coming to the rescue. After all, if businesses have cheaper access to capital,
let's not also forget that there is also a difference between those who are unemployed and also a vast majority of people who are underemployed, meaning that they have to work multiple jobs, including gig work, just to even afford like their basic needs. So this number may actually be worse than what we're seeing on paper.
The more likely they are to reinvest, the more money people should have left over to spend on everything else, and the more this should help prop up the entire economy. Now, in terms of where these jobs are going, it appears as though AI does have some effect. Like even the Federal Reserve said that industries which use AI are seeing a higher unemployment rate than those which don't. So that's something to consider, especially now when one person is able to do a lot more work than they were previously. Although in terms of what else Jerome Powell just said, overall, he was a lot more cautious about the economy than in previous meetings. He still mentioned a concern of whether or not tariffs would have an impact on inflation, and that's why they're taking it meeting by meeting to determine what's going to happen next. However, in terms of where they expect the market to move over the next few years, today is where they release what's called their Summary of Economic Projections, which details exactly what they anticipate to happen in the near future. And now the Federal Reserve has made it clear that they expect to cut by another 50 basis points by the end of the year due to growing job uncertainty. On top of that, they're predicting that inflation will remain above 2% throughout 2028, suggesting that their plan is overall to cut aggressively in 2025 and then take it a bit slower throughout the next year depending on the data. Beyond that, Jerome Powell went on to say that today was a risk management cut and that job growth was below break even. So the market currently believes that the Fed might be too late to cut interest rates, which is why everything has begun selling off towards the end of the day. So overall, in terms of what I think, look, the jobs numbers were pretty bad, and it's not surprising the Federal Reserve is stepping in to rescue the market, even though they're doing that at a time when asset prices are near an all-time high and inflation remains elevated. This is going to be a really unique spot for them to be in, because on the one hand, if they lower interest rates too much, they risk inflation coming back, but if they wait too long, they risk the unemployment rate rising. It's going to be a really delicate balancing act, not to hurt one for the sake of the other. That's why I wouldn't be surprised if we see another small rate cut when they meet in October, and maybe another one when they meet in December. I'm fully expecting them to take it a bit slower than expected. And with Powell's term ending May of 2026, next year could be very interesting if Trump appoints somebody who pushes for even more rate cuts than we're seeing today. But please let me know what you think of this down below in the comment section. I will do my best to read and reply to as many of you as I can. And if you haven't done it already, hit the like button, subscribe. Thank you so much, and until next time.
I could tell you, based on the fact that the Federal Reserve already made these rate cuts, they're anticipating more. Jobs numbers are not looking good. That means that they know, okay, we need to fix this now before it gets worse. And basically, they're trying to plug up holes in the boat. I think they did it too late. I think they should have cut rates even earlier than this. But it is going to be very interesting to see like what happens in the next 6 to 12 months. Hey, thanks so much for watching. If you want more videos, you should check out these next. And if you don't want to miss a live stream, do me a favor, hit that subscribe button below. I'll see you in the next one.